The financial industry often claims that socially responsible investing is a win-win, doing well and doing good. My research suggests otherwise. If you're not willing to take a financial sacrifice, you will not have impact on what companies do. Think about an investor who dislikes carbon emissions and tries to steer firms towards making less carbon-intensive investments. The traditional way people have thought about doing this was by divesting or threatening to divest, meaning an investor tells a company that they will sell their shares unless they reduce their carbon emissions. The issue with that is that as one investor sells, there is a lot of profit-seeking capital out there that just might buy these shares. And so it's not clear that divestment has had big impact on what companies do. What I've been interested in my research is whether the opposite, investment, can potentially induce companies to change their ways. What I find is that that is indeed possible, but that doing so requires a sacrifice in terms of financial returns on behalf of the socially responsible investor. I arrived at this conclusion by writing down essentially a canonical corporate finance model, but giving companies a choice between a more profitable but dirty or high-emitting production technology and a cleaner production technology that is more expensive to set up. What this means is that for large investors, say pension funds or other asset managers, they have to be concrete about what type of trade-off between financial returns and non-financial outcomes their investors are willing to accept. Financial markets can play an important role addressing some of society's most pressing problems. For example, our transition to a lower carbon economy. However, doing so requires understanding exactly what it takes for investors to achieve this outcome. So as a society, we have to ask ourselves how much of a lower return are we willing to accept in order to make the world a better place.